early 2018, we saw a rising trajectory for growth. Today, instead, we see growth moderating ahead. FOMC participants, along with many other forecasters, had long predicted some moderation of growth in 2019. The additional tightening of financial conditions we've seen over the past couple months, along with signs of somewhat weaker growth abroad, have also led us to mark down growth and inflation projections a bit. The median of FOMC participants' projections shows growth of 3% this year and 2.3% in 2019. With growth remaining next year above its longer-run trend, the unemployment rate is projected to fall a bit further to 3.5% by the end of 2019. Inflation in the median projection remains near 2%. Second, the economy has continued to strengthen this year, and given our 4 rate increases and the ongoing reduction in our portfolio, monetary policy will be providing a smaller boost to the economy in 2019. After today's action, the target range for the federal funds rate is 2.25% to 2.5%, putting it at the lower end of the range of estimates of the longer-run normal rate provided by the committee. Over the next year, if events play out broadly as expected, the federal funds rate will be in a range in which judgments of people both inside and outside the Fed will sometimes differ regarding whether the stance of policy is now modestly accommodative, neutral, or modestly restrictive. For indications that the stance of policy is appropriate to sustain the expansion of a strong labor market and inflation near 2%. It's worth noting that the summary of economic projections is a compilation of the individual projections of all FOMC participants. We sometimes point to the median of these projections to illustrate the broad middle of views of the committee. Each participant's projection represents appropriate policy under the baseline outlook provided by that participant. We believe that the SEP provides useful information about it. The median is not a consensus judgment and certainly does not represent a committee plan. Actual policy will, as always, be adjusted as incoming data shed light on the state of the economy, the outlook, and the changing balance of risks. Neither the pace nor the ultimate destination of any further rate increases is predetermined. We will adjust monetary policy as best we can to keep the expansion on track, the labor market strong, and inflation near 2%. We know that our policy decisions affect all American families and businesses, and will continue to make our decisions objectively and based solely on the best information and analysis. Thank you, and I'll be happy to take your questions.
All right. Question time.
One of the recent surprises has been fairly tepid inflation data. I wonder, first of all, if you could explain why you think, despite the extremely tight
Markets have reacted fairly tepidly.
much in the way of inflationary
Not very
in the context
bullish nor bearish. Had a little sell-off here, but some nice accumulation thereafter.
to further undershoots of inflation moving into next
Still listening to the press conference here.
Well, you're right, Sam. Inflation has come in just a touch.
You see on the daily here on the NASDAQ. No major changes here.
Up by a small amount. Low unemployment and strong growth, and inflation has still remained just a touch below 2%. So I do think that gives the committee the ability to be patient in moving forward. As I mentioned, there's significant uncertainty about both the path and the ultimate destination of any further rate increases.
Hi, Heather Lum from the Washington Post. Today, the Fed lowered its expectations for interest rate increases. Given that, I'm wondering if the Fed has had any discussion of altering the course of balance sheet normalization, and if you could give us any insight on what might lead the FOMC to alter that balance sheet normalization in 2019.
Sure. If you go back some years, I think people who were working at the Fed in 2013 and 14 took a away the lesson that the markets could be very sensitive to news about the size of the balance sheet, the pace of asset purchases, the pace of runoff, and things like that. So we thought carefully about this.
A little bit more selling.
Policy
It doesn't appear to be a bear flag. Could be. I mean, it looks like one, but the volume.
on automatic pilot.
I guess it could be indicative of a bear flag.
Rate policy.
If that's your flagpole and that's your volume you're going off of, that could be declining volume.
And I think that has been
Definitely declines there. So,
that the runoff of the balance sheet has been smooth and has served its purpose.
so what I was talking about earlier is if the Fed led us to a potential
We will continue to use monetary policy, which is to say rate policy
situation where
is the active tool of monetary.
they're kind of neutral and stop raising rates and the market still sells off, then we're not really concerned about the Fed. And it could be a possibility of what's going on here. Seeing a little bit of selling.
To be patient. And so as you think about your next policy moves, are you inclined to go at the current recent pace to a slightly different destination that's laid out in the projections today? Or does the current environment...
So I pulled, I had Apple.
maybe
So looking to see what Apple did.
out your next
Apple actually selling off. Amazon also selling off. So looks like a sell the news. Not necessarily even buy the rumor, just straight up sell the news.
Forward to 2019 and still having what amounts to a positive forecast. We still are forecasting individually growth a bit above its longer run potential, 2.3% is what we're forecasting. We're forecasting that growth will be strong enough that unemployment will drop still further.
Is anyone out there? Can someone try to type in chat? This is the same old chat with some posts. If you guys could do that, I would appreciate that. Just type something, hello. I'm not quite sure if chat is working or not.
In fact, on that path, that the development of the economy is in line with that expectation. That will be the main thing.
What's doing? Okay, there you go.
I think
Thank you, Ian.
we've reached the bottom end of the range of committee estimates of what might be neutral. I think from this point forward, we're going to be letting the data speak to us and inform the outlook and inform our understanding of what the appropriate policy. So there's a fairly high degree of uncertainty about both the path and the ultimate destination of
Thanks, guys.
increases.
I'm watching the live stream on the other screen here.
Chairman, Steve Leisman, CNBC. Could you tell us how three things affected the outlook for the economy and rates? The first is how the market's decline affected the outlook for the economy and for rates. The second is trade tensions and the tariff war, how you factored that into your outlook. And the third is comments by the president urging you not to hike rates.
So as I mentioned,
Moving towards the low of the day on elevated volume, so that's not a good thing. Looks like we're moving lower.
including financial conditions, a broad range of financial conditions. And we took on board the tightening in financial conditions, which not any one condition, but broadly speaking, financial conditions have tightened since the September meeting, really. So we took that on board in our forecast. That's why the forecast for growth and inflation went down a little bit. But remember, that's in a context of a more accommodative path. So we also took down our rate forecast. So we definitely did take that into account. And as you can see from the statement language, we acknowledged those risks in the clause about monitoring developments. And we're going to be watching carefully to see as those things develop. I think more broadly there's been a sense of concern among business people and market people about global growth. And, that may be partly about trade tensions. It may be partly about a variety of things. If you just mechanically drop into a model of the U.S. economy tariffs, you don't see very large effects. The large effects would have to come from financial market changes or from losses in business confidence. And those are things that are very difficult.
like he was
On
wearing
your third
black
factor,
shirt.
political considerations have played no role whatsoever in our discussions or decisions about monetary policy. We're always going to be focused on.
He just said, I don't listen to Donald Trump.
We have the tools to carry it about. We have the independence, which we think is essential to be able to do our jobs in a non-political way. And we at the Fed are absolutely committed to that mission, and nothing will deter us from doing what we think is the right thing to do.
New York Times. You're about to undershoot your inflation target for the 7th straight year. Your new forecasts say that you're going to undershoot it for the 8th straight year. Should we interpret the dot plot as suggesting that some members of your committee believe that policy should be in a restricted range by the end of next year? If so, can you help us to understand why people would be advocating restrictive monetary policy at a time of persistent inflation undershoots?
Well, we,
Good
as a committee,
question.
do not desire inflation undershoots. You're right that inflation has continued to surprise to the downside, not by a lot though. I think we're very close to 2%. And, you know, we do believe it's a symmetric goal for us. Inflation is symmetric around 2%. And that's how we're going to look at it. We're not trying to be under 2%. We're trying to be symmetrically around 2%. And I don't, you know, I've never said that I feel like we've achieved that goal yet. The only way to achieve inflation symmetrically around 2% is to have inflation symmetrically around 2%. And we've been close to that, but we haven't gotten there yet, and we have not declared victory on that.
It's funny.
That remains to be accomplished.
Hi, Gina Smilik, Bloomberg News. Just following up on Vinya's question, I guess if you haven't achieved 2% inflation and you don't see an overshoot, which would be sort of implied by a symmetrical target, what's the point in raising rates again at all?
So again, I go back to the health of the economy. If you look at 2018, as I mentioned, this is the best year since the financial crisis. You have growth well above trend. You've got unemployment dropping. You've got inflation moving up to 2%. And we also have a positive forecast, as I mentioned. And in that context, we think this move was appropriate for what is a very healthy economy. Policy at this point.
I'm actually listening to the FOMC press conference, chiming in when I feel like it. Sorry, Paul, and everyone else listening. May not be able to hear that. Let me turn it up.
I also think we took on board, you know, the risks to that, and you know, we're certainly cognizant of them.
Mr. Chairman, Marty Kretzinger with the AP. You've established for this coming year a communications panel to look at how the Fed communicates. Could you talk a little bit about what you expect
There you go, there's the Fed.
To get from that panel? And will the dot plot be involved in that at all? How do you think the dot plot is working?
Thanks, Paul. I should have done that earlier.
Dealing with it the way that you want us to be handling the dot plot, or is it something that you might tweak a bit?
So this review, what it really is, it's coming at a time when the economy is strong, and it's a good time to take a step back, we think, and ask whether our strategy and our tools and our communications around monetary policy are doing the job that Congress has assigned us to do on behalf of the American people. And what we're going to do is we're going to open ourselves up and have a discussion with many outside groups of all different parts of the economy, including an academic conference in June in Chicago. And again, the idea is to listen to new ideas, better ideas, old ideas. Many of them have been around, and try to assess whether there are better ways we can do things. One of the overarching facts is that rates have been really coming down overall for more than 3 decades now. We may be in a world where interest rates are just
the Fed has nothing to do with Bitcoin,
saying we'll have less policy space to react to economic downturns.
That'd be pretty bullish, though.
Evaluating ideas for, again, for better achieving the goals that Congress has given us. We're not looking at law changes at all, and we're not looking at changing the inflation target, for example. We are looking for better ways to achieve the inflation goal, for example, on a symmetric basis. So that's the sense of that. So as I mentioned on the dot plot, you asked about the dot plot. I think the dot plot generally.
So the way this
does
is behaving
provide
right now, it's not really necessarily looking great for the markets in terms of this announcement. Dropping on the announcement, we're having another leg lower.
I think people
Here's the
sort of
first
have it
leg,
figured
little
out
mini
and
bear
understand
flag.
what it is and what it isn't, but that doesn't mean we don't like to repeat what it isn't. Which it's not a consensus forecast. It's not something that we vote on. It's something that each of us writes down, and we always update it as data come in and as we update our outlooks.
Well, so here's the problem. The Fed always lends money. The problem, I don't think, is necessarily the rate, although that's
the balance sheet
hold on.
reduction. How much additional
Balance
tightening
sheet reduction.
do you think has come
That's
from
important.
that? We note in the markets that the cost of credit rising, commercial paper, repo rates, the TED spread widening. Do you see any concerns about the availability or the price of credit that could slow the markets? And if in 2019 we see the economy start to slow, would you, if you don't adjust the balance sheet, be risking too much tightening?
So we do watch all of that, but the amount of runoff that we've had so far is pretty small. And if you just run the quantitative easing models in reverse, you would get a pretty small adjustment in economic growth and real outcomes. So we don't think, things that are happening at the short run, at the short end, are driven by many other factors other than the balance sheet runoff. For example, just very large bill supply has pushed up short-term rates, has pushed up repo rates. Tightening of the federal funds rate has raised short-term borrowing costs. So, we're alert to these issues. We're watching them carefully, but we don't see, the balance sheet runoff as creating significant problems.
Evan Lawrence, Fox Business Network. Thank you, Mr. Chairman. We've seen enormous volatility in the markets recently. We know the president said, don't raise interest rates. That's well documented. The National Association of Realtors chief economist says that it's starting to affect first-time home buyers with the mortgage rates going up. When do you think these pauses need to come in next year? Do we need to keep this, as you say, gradual? And then, in addition, what data are you specifically looking at for you that shows when the Federal Reserve starts to become that headwind in the economy with the rates?
We're watching. We have a strong forecast generally for next year. That forecast involves growth at between 2 and 2.5%. It involves growth at a strong enough level to continue driving unemployment down and inflation near 2%. So that's a pretty positive forecast. So to make further moves, I'll be looking for data that suggests that that's in fact the path that we're on. As I mentioned, once you're broadly speaking in the range of neutral, I think it's appropriate to be putting aside individual estimates of that and be looking at what the incoming data are telling you about the outlook, updating your estimates of what neutral might be, of what the natural rate of unemployment might be, of the state of the economy. So, and letting that lead you to adjust your outlook and therefore your appropriate path for policy. So that's what we mean when we say we're data dependent. Of course, we're always data dependent, but I think it has a particular meaning in this context, which is that.
Hi, Mr. Chairman. I wanted to ask, first of all, whether you're worried that President Trump's tweeting and statements might interfere with your ability to communicate with markets and why you're doing what you're doing. And then also I was wondering if you could comment on Governor Brainerd gave a speech recently where she laid out the case for the countercyclical capital buffer being activated. Do you disagree with her analysis? Is that something that you think the Fed should look at doing?
I'm not worried on the first question, because I know, and everyone who works at the Fed knows, that we're going to do our jobs the way we've always done them, and that involves, getting the best thinking together, diverse perspectives. Every business cycle, every FOMC cycle, we talk to hundreds of people in all
So
different
the market's
parts
slowly
of
moving lower here. Nothing
Not
super
just
bullish
people,
out of them.
market people, but people from community development organizations.
Like I stated before, if we get
thousands of people,
something that
and
should
so
be
we really do
perceived
have
as
a
bullish,
pretty
but we
broad
continue to sell off, it
exposure to
means that
what's
they're
going
not
on in
necessarily super
all
concerned
different
about the
parts of
Fed.
the country. And we're going
And
to take
that
all
may
of
be
that
a
information
possibility
and we're gonna
here.
make the best
You can
decisions
see
we
here's the
can
daily
about
on the NQ, and here's the
causes to
QQQ intraday on the 5-minute chart.
In terms of the CCYP,
Two different visions of the same
so the
story
CCYP
here.
is
So,
a countercyclical capital buffer,
pretty
which is a
ominously
tool
red
that,
over
allows
here,
us to build capital
and it looks like we're
at a
undercutting
time
the previous day's
when,
lows over there,
vulnerabilities,
and
financial
today's
stability
lows as well.
vulnerabilities
So
are
definitely selling
meaningfully
off a
above
little
normal.
bit. There was a bit of a
that's
risk
tool
here that
I'm
towards the end of the day,
absolutely
and even
willing
after
to
hours,
use
especially
and
with the
happy to
futures
use
market,
at such time as
you
that
see a
test
big
is
rally
made.
after the close.
We meet and
If
discuss
they're letting
that
it
and
sell off
evaluate
here,
it,
it's not
on
really
roughly
a
an
crazy
annual basis.
sell-off.
We
It's just
haven't
kind
done
of
it since early
slowly
this year. I think
drifting.
we'll be doing it early
So if we
next
get
year,
towards
we'll
the
be
closing, you
reaching
start
that
to see some
judgment.
big bullish green
Then I will
candles.
tell you,
Make sure
I
they're buying
recently gave a
candles, and
speech
then
saying that I
could be a
believe
little
that
signal for a
financial
rally
stability
if
vulnerabilities
this
were
actually
roughly at a moderate level.
is
So for me,
pretty bullish
but I would want to leave
Fed statement.
my
But
mind
so
open
far,
on that and have that discussion with
so
my
far,
board colleagues,
market
when
isn't
the
really
issue
taking it
arises.
very well.
Ann Safir with Reuters. You said that policy does not need at this point to be accommodative, but does it need to be restrictive, as the dots seem to suggest that it will be?
Well, it doesn't currently need to be restrictive, no, and I don't believe that it is. I don't believe that policy is restrictive.
Next year. The dots suggest it will be restrictive next year. Should it be?
Yeah, I've discussed this a couple of times. It's a very good question, and I guess I would just go back to this. The individual forecasts are not something that the committee votes on. They're out in the future. We vote on the rate increase, and we write down our own personal paths. So people have disparate views on what the endpoint could be. Ultimately, it's going to depend on what the circumstances are. There would be circumstances in which it would be appropriate to go past neutral, and there would be circumstances in which it would be wholly inappropriate to do so. So I wouldn't put too much on. I mean, it does inform you the way people are thinking about things, but I wouldn't take it as a signal about current policy or about near-term policy.
Hi, Paul Kiernan from Dow Jones Newswires. Thanks for the question. In Dallas last month, you talked about the usefulness of speaking with businesses to sometimes hearing things that aren't yet showing up in the economic data. And I was just wondering if you're hearing anything from businesses that might explain the recent market moves. Are markets onto something that, again, hasn't showed up yet in the data? Thanks.
So if you look at the Teal book, or we get the Teal book in person from the Reserve
Here's the
Bank
market
presidents who
question.
come in and they share their discussions, not just with their directors, but with literally hundreds of business and nonprofit, and labor union people around the country. And I personally find it really interesting. I mean, my background is very much working, starting with a small group of people, maybe a company, and working out. So that kind of anecdotal data really helps me capture the picture better. So, and what you're picking up now, I think, is there's a mood of concern, or it's a mood of angst about growth going forward, if I could just capture it in one thought. There are many reasons that are given for that, but generally speaking, it's a concern about, is growth going to be as strong as it was? Why not? What might it be? Different people, but that mood is out there. That doesn't mean that it'll come into the real data in a big way. It may, or that financial conditions will tighten further. We'll just have to see. For now, financial conditions have tightened a little bit. We've taken that on board, both in the outcomes in our forecast, but also in a lower rate path to provide some accommodation to push back against that tightening. That's how I think about it.
Okay, Greg, and then Nancy.
Greg Rupp from MarketWatch. Just following up on Paul's question, President Trump said recently that you should feel the markets. So when you see the markets, what are the markets telling you?
Financial conditions, broadly speaking, we don't look at any one market. We look at a really big range of financial conditions. And what matters for the broader economy is material changes in a broad range of financial conditions that are sustained for a period of time. A little bit of volatility, speaking in the abstract, some volatility doesn't probably leave a mark on the economy. So we look for that. And what we've seen here is a tightening. There's been a tightening since right around after a week or so after the September meeting, and that we've tried to factor that into our models of the economy and to the results that come out of those models. That's how we think about it.
So market here, not
we follow markets.
Hearing stuff they really like,
but
not
remember,
yet.
From a macroeconomic standpoint, no one market is the single dominant indicator, and it really matters if changes are sustained over time.
Nancy, and then Donna.
Nancy Marshall-Genzer with Marketplace. Do you still think core PCE
Good question there, Michael. Good question. Apparently not.
Overheating.
Well,
what do you think of other measures like setting a target for economic growth and relying more on that?
Well, I think we We look at both, but core PCE is a good indicator. It has what's happened over really 50 years.
So I think Michael, a good answer to that question is that the market, and I talked about this a little bit earlier, there's a possibility that these numbers are forecasted in, and they're concerned about other things like peak economic growth. Like if the U.S. economy can't grow anymore, at least in terms of upward, not that it's going to go into like a negative, our GDP is going to slow, but we're going to go from 4% to 3% to 2%. I think that is probably more likely what is causing our downturn than the Fed. So keep in mind, guys, the Fed's the news story right now. But earlier this morning during my daily live stream, which I do about 15 minutes before the market opens to about 15 minutes after the market opens, give or take on either side of that. If the market already knows what it's going to do, it uses all of these things as an excuse to do what it already wants to do anyway. Hold on, I want to hear the question.
Next year, every meeting will be a live meeting, so presumably there will be some adjustment in how the market anticipates when a rate hike is coming. How has the committee thought through communicating those potential policy moves, especially in light of the fact of the tremendous amount of uncertainty going into next year?
I think having regular press conferences will be a big gain for communication. I certainly hope it will. That's the plan. And so being able to come out after each meeting and explain the committee's thinking and relate that to the state of the economy and expectations for policy and global developments, I think it'll be, the idea is that it'll be helpful in explaining how we're thinking and, explaining what we're thinking about policy going forward. So that's the plan. I do believe it will be a positive development. I think it'll also become the case over time that there will be no prior as to whether we would move at a quarterly meeting or one of the meetings at which we do not file an SEP. As you know, we only update our projections under the current approach quarterly, whereas we have eight meetings. So I think we'll move to a more we'll have the ability to move at 8 different meetings, not 8 times, but at 8 different meetings on the year.
I guess that's sort of the question that I'm trying to drive at is in terms of communicating to the market, because the market's been so adjusted to the fact that these are quarter-end rate hikes, and now you have the potential to move 8 times a year. Is the Fed thinking through how it's going to communicate when it plans, especially given the amount of uncertainty?
Yes, I think that's probably pretty straightforward. If we want to communicate something about something that's going to happen at a future meeting, I think we know how to do that in speeches, in press conferences and such.
Don Lee with the LA Times. You mentioned broad-based wage gains this year, and wondering if you see further acceleration in wage growth and just how much slack there is in the labor market.
So what we've seen is a very gradual and I think ongoing increase in wages. If you go back a few years, you'll see that we look at many indicators of wages and compensation, but there are 4 principal ones, and they were all kind of clustered.
So the market not really liking what they see here at all. They were looking for some relief from the Fed, probably to sustain what I was talking about earlier in regards to, yes, these rate hikes probably are priced into their models, but they're noticing something else, whether it be the trade war, which the Fed chairman, it sounded like he said the trade war was not a huge issue. I'm not sure if that was in regards to inflation, but market selling off here, definitely undercutting lows. We talked about in our live stream these lows being less aggressive, so that's no longer the case. We're moving back into, at least if we stop now, a more normalized aggression, still in a downward trending channel. If we stop here, we'll have to wait and see. So that's about when, that's about, where we should stop if you think this channel is gonna continue. So debt of bubble Trump bubble now confirmed? Maybe we'll have to see.
On the labor market. And by most indicators, we are at or even above longer run normal levels. But I would point to one particular pocket, and that is labor force participation by younger prime age workers, particularly prime age males, is still meaningfully below its pre-crisis level. Most other age groups in both genders have moved back up pretty close to where they were at the last cyclical peak. There's a question: can we go above that cyclical peak? And or are the problems more structural than cyclical, and that there isn't? So we'll have to find that out. I think, given a strong economy, we've had the luxury of finding out that labor force participation can be higher than we had thought, and that's nothing but a good thing.
Hi, John Heltman with American
There's
Banker.
some interesting,
a
interesting candle.
Question, if I may.
Volume elevated down here. We talked about buying
many of
it,
the
or
Fed's
not buying, but we talked about it bouncing
so
here at this
far,
lower trend line, so we're getting a little bit of that.
Have been primarily focused on banks in the sort of medium to small.
Another hour until the
range. That
close.
is,
We'll see how this works
sort of
out.
Tailoring enhanced prudential standards, particularly for those banks, and I'm thinking of the stress capital buffer, as well as the most recent proposal on banks between 100 and 250 billion. GSIBs and the largest banks seem to be sort of left out of a lot of these proposals, and I'm wondering if that is meant to send a message that the Fed does not really intend to change its regulatory structure for the largest banks going forward, or
NQ's actually bouncing off that
you'll
bottom
get to
there a
that
little bit. We
maybe
talked about
later.
that a
I'm
little bit
thinking
ago.
specifically of the
So far, the
GSIB
highest volume
capital
candle here of the
surcharge,
day,
which,
right here on this
several members of Congress have
on
sent
this bottoming
letters to
candle.
asking
So
you
we
to
could still be
revisit
stuck in
the
that
GSIB.
channel. Like I said earlier,
So you're right.
I say that a lot because I say a lot
big
of things.
focus
but,
of what we have been doing has been tailoring regulations. In the sense of tailoring,
we have a possibility here of
is
some kind of
that we want to look
a reversal in
below
the
the
market
level of the
action.
GSIBs at the
They like
large
to play
regionals and
games.
then
That's all I
on down
got to
to the
say.
community banks at
They just
various
like to play
steps,
games.
and ask whether we have appropriately tailored regulation and supervision to account for the fact that smaller and less complex organizations present a much less significant threat to the economy and to the community should they fail, should they experience material difficulty. So in the nature of that, you're focused more on the smaller institutions. I think with the larger institutions, we want regulation and supervision to be effective and efficient. I know that the larger institutions tend to be the ones who care about the Volcker Rule. That's something we're working on. We think things need to be looked at carefully, and I wouldn't want to materially change capital levels because I think it's important that the largest financial institutions, the largest and most complex, the systemically important ones, be held to the highest standards and higher expectations. And while we may tailor some regulations, those fundamentally high expectations are not going to change.
Okay, Steve and then Courtney.
Steve Beckner, freelance financial journalist, reporting for NPR, Chairman Powell. I know you look at many different financial indicators, but let me focus your attention briefly on bond yields. The 10-year note yield has gone down pretty steeply, roughly 50 basis points, I think, in recent weeks. Wonder what you make of it. Is it a worrisome sign for you in terms of the outlook for growth, for inflation? On the other hand, could it be a positive in terms of presumably bringing down mortgage rates and helping the housing sector?
Again, we do focus on a broad range of financial indicators, and we don't obsess about any particular one. We look at a whole range of them, and we ask ourselves what's really going on in the broad picture out there. If you ask what's going on with the longer maturity Treasury market has come in some. That's consistent with a risk-off feeling in the stock market as well. And we don't know whether that'll persist. Really, the longer Treasury has moved in a range above 3% and down 3% as the risk sentiment has changed. You know, I think if rates were to stay low for a longer period of time, that could be thought of as a signal of expectations of lower growth, but you know, we don't know that that'll happen. As I mentioned, our forecast for next year is, I think, in keeping with most other forecasts, is that
Yeah,
we'll
Eli,
still
no
have
no major bounce
solid growth
here,
next year.
but it is a bottoming candle of sorts. You got to respect that. There's quite a bit of volume right there on that 5-minute on the cues right there. Someone took a position.
I'm wondering if you can clear up what's become a little bit of a debate in the financial community. You said in October in an interview with PBS that interest rates were a long way from neutral. A month later, you said interest rates were just below neutral, and I think a lot of people interpreted that as a shift in tone from you. Were they right to interpret it that way?
You know, monetary policy is a forward-looking exercise, and I'm just gonna stick with that. It's where we are right now.
Yeah, well, a bottoming candle isn't necessarily the bottom. It could be the bottom for the day. We could be rallying the rest of the day. Like I mentioned a little bit ago, we kind of have this little trend line here. Let me actually extend this one out.
There's real uncertainty about the
So we're sitting right there. This is that channel we've been in for a while there. We've seen bounces from here. So we could see a reaction all the way up here. This could be one of those situations where they sell on the Fed announcement and buy later. Like I said, you think crypto plays games. Crypto plays no games, really. The stock market likes to play games, and this is something that you could see is this type of a game where you have a big sell-off and then an even bigger buy opportunity later.
Economic developments you're referring to, whether Brexit is one
So
of those.
not saying we're rallying all the way up from here, but that's a possibility if you did want to take a position with a stop down here. Wouldn't be the worst position in the world. Fairly low risk, but if it tanks, you got to jump out of that trade. Because
people raise their forecasts.
So here's the thing: the Fed isn't like tightening further, and someone else said, "Isn't this already priced into the model books?" You have to think that it is. You have to think that it definitely is. So
modest retracing of that. So you have
well, yeah, no,
levels of growth.
you're missing what I'm saying, Eli. I'm saying a bounce.
Close to the
I'm saying a bounce. I'm not saying this is the bottom. I'm saying a bounce.
But you no longer have the really
You know,
strong levels.
a lot of people are traders in here. Traders trade ranges, trade bounces, trade breakouts. So this would be kind of a bit of a bottom play here if you wanted to play that. We had a bottom day that happened here the other day that only went up for about 3 or 4 days, and that was a bounce. We could do something similar here, but anyway, all I'm saying is that is a bottoming candle of sorts. What it leads to is anyone's guess.
Institutions have had a long time now to get ready for the full range of possible exits from the EU by the UK, and they've had supervisory involvement from U.S. supervisors, from UK supervisors, from EU supervisors. We think they are fully prepared for the full range of outcomes that may come out of that. I was very happy to see the developments around central counterparties today. That was a big issue that seems to have been satisfactorily, for the time being, resolved. So it's something we're watching carefully. Honestly, it shouldn't have major implications for the United States, but you know, there's a lot of uncertainty because it's not something that's happened before. So we'll be watching it carefully.
Thank you.
Thanks very much.
All right, so it looks like that's the end of the Fed meeting. Congratulations, ladies and gentlemen. Sorry I was not here for the beginning portion of that. Time really got away from me, and it is what it is. But so there you go. We had a bit of a sell-off. We have a little bottoming candle. We'll see what this means going forward. That did bring us all the way back down to our channel that the market was forming ever since we had these 4 points. We've been able to draw this channel, and we came down and touched that level. So is that the bottom? It definitely could be for a short-term bounce of some kind, whether it leads into a rollover later today or 3 days from now or 2 months from now. Who the heck knows? You never do know where these things are going to bottom, but that is a potential bottom. If it gets undercut, then all that goes away. Is what it is, guys. It's trading. It's trading. It's a bunch of opportunities. You just have to decide what you want to take. So, yeah, no major bounce right now. Anyway, we'll see what happens. The Fed did raise rates. The market did not want that. But was it built into their models? I like to think that it was built into their. These guys aren't dumb. The Fed doesn't necessarily kowtow to the market at every point, and so I think 72% of the people expected a rate hike, and so they got it. And then, why would you get an extreme sell-off if 72% of people expected a rate hike? I think it's just the next thing to talk about. After this Fed rate hike, we'll see a little bit of a reaction from this over the next, maybe tomorrow, maybe. And then after that, we'll have to go ahead and see what the next shoe to drop is. Is it going to be some economic number? Is it going to be an unemployment number? Is it going to be trade news? Is it going to be we're going to arrest the Samsung CEO next? I mean, again, a very news-driven market, which is what you do not want to see. We've been discussing that over the past couple of weeks, is that this is a very news-driven market. News-driven markets by nature are very hard to predict and very hard to really get a huge beat on. But, we've been in a downtrend. We're going to continue in the downtrend until something turns us around. And best action is to sit tight and watch this development. Yeah, pretty much. I agree with that. Arrest Saudi prince, ask for ransom. Why is my son on the street corner with an umbrella? Anyway, for those of you that don't watch me all the time, my son's usually with me, and he went outside and is standing on the street corner. We have a little curb on the street corner, so he's just chilling with his Thomas the Train umbrella, his Lammy, and he's walking back home now. Anyway, selling off a little bit more here. So, like I said, a bottoming candle doesn't mean that it's going to bounce, but it could. If we break down further from this channel, that's going to be very bad in my opinion. That means that we're accelerating the selling, and that would lead to very bad things. Very, very bad things. So, are we getting that accelerated selling right now? It just dropped. Looks like we fully retraced that prior candle. So no bueno. We already undercut this low, so we're definitely still back in a correction. We had a couple follow-through days in the market. We had one here that immediately didn't work, and then one here that worked for a little while. Market went back into a correction. I think that was Monday, or maybe that it was Friday. I'm forgetting, but yeah, so still in that correction, undercutting low. So at this stage of the game, guys, again, I'm not trying to sound bullish. Maybe I do. Eli always tells me I'm sounding bullish, and I agree. I probably do sound a little too bullish. But we never stop looking for the follow-through day. You never know when the market's going to turn around. Sometimes there's no signal. Sometimes there's a signal, but you always have to look for the follow-through day. No market uptrend has started without a follow-through day, but not all follow-through days work, and we've already had 2 failed ones here during this correction. And what is leading into a bear market, actually, how far are we down now? We were down 16.5%. Now we're down 18.5%, so definitely leading towards bear market territory. Definitely leading that way. So we'll have to see how we close, see how futures close, see how the overnight session occurs, and kind of go from there. But a little bit of a bottoming candle, that may be the bottom for the day. If it's not, that's not going to bode well for tomorrow by any stretch of the imagination. Brian says Amazon broke. Yeah, let's look at some of the leading market cap coins. So I did notice Amazon was weaker earlier. A big outside day today, as a matter of fact. So an outside day is where the high is higher than the previous day and the low is lower than the previous day. And this is not a bullish outside day. This is a bearish outside day. Volume already pretty much equal with yesterday's volume, so we'll have an elevated selling day today. Not good for Amazon. Let's take a look at Apple. Already making new lows, so Apple definitely not done with its route to the downside. Also, similar situation with the volume. Microsoft has been kind of a strong point in the market, and so far looking like it's retesting these low levels. There's quite a few wicks down here today, and there's a stalling candle on Microsoft. Again with a lower high and an outside day on a bad day. We'll see here. So Looks like we're getting ready to try to test the lows of the day. That bottoming candle may not mean a whole lot. Could just been short covering. You never know. You never know what a candle implies. Short covering, buying, until a few candles later. Ah, you got Lammy on a leash. Nice. So, testing the low of the day. So far being supported. We'll see what happens. So what did you miss? Well, I gave the ultimate portfolio guide. So everything you need to trade stocks effectively is what you missed, Blay. I gave it all away. Gave away all the secrets. Well, either way, I'm actually, we'll see what the next 20 minutes or so hold. I'm not super enthused with this action so far. Usually with a bottoming candle of this nature, you should continue, and we have not. We have not continued. It wasn't even that large, to be honest with you, but you could see it eating a little bit of order book right there. All right, let's take a look at my list. So my list here, if you guys are new to my channel, thanks for joining me. If you're listening to my son James destroy my office. So I do a live stream pretty much every single day that the markets are open. And I do it in the mornings, about 15 to 30 minutes before the market opens or so. And we've kind of been walking through the markets here, and looking for some kind of signal of the selling abating, which it is not doing so far. It looks like it's still there, but a little bit of buying there. The volume's not very impressive, however. And this list here that I'm scrolling to the left side of my screen, this is my general watch list here. That's comprised of about 100 or so stocks, and it's leaders from various market segments. And it's usually not very good when the screen isn't green, when my one screen here isn't green, and it looks like it's not fully green. Have some red creeping in. Eli Lilly looks like it's had a good little bounce day today, but if you look into it, it actually was up much further and has been selling off throughout the day. VMware was also holding up pretty strong. We dropped the other day back beneath this trend line, so now we're kind of bouncing around the 50-day here, which is good so far. We'll see if that maintains. A little bit of buying there. So we are seeing some support down here. Some support. We'll see what the rest of the market session gives us. Thoughts on Nike? Well, we were actually looking for Nike to hold this trend line right there of the prior high on this weekly chart. So far, that's not occurring. We have earnings coming up. When is that? Tomorrow aftermarket. So earnings tomorrow aftermarket on Nike could be a little bit of a bellwether on the economy. There's a bit of a buying candle right there. Still haven't reached these highs though on the Qs. The Qs are Nasdaq ETF. Still haven't broken that by any stretch of the imagination. And volume's not very exaggerated either down here, which is kind of a bullish sign, to be honest with you. Not bullish and we're going to run to the hills, but bullish and maybe we don't crater into the floor any more than we already have. But back to Nike, yeah, I don't really do much in front of earnings. Earnings are a gamble in either direction. So 2 days, pretty much earnings are tomorrow after hours, so I really wouldn't be getting too aggressive with Nike. The chart overall looks very neutral. It's not super bearish. You can see in the weekly chart here, the volume has just been declining. They haven't really been selling Nike off, which is good. It hasn't been selling off too much. I mean, everything's been selling off. So we're down here about 20%, which isn't bad on Nike. That's actually not bad. But I would buy them after earnings if you were thinking about doing that. I would probably wait until after earnings. If a lot of people want to buy before earnings and they think they're going to get a huge boost out of earnings, but that is a double-edged sword. It does move in both directions. Rate increase, good or bad for markets? I honestly think it's neutral for markets. I think they were kind of looking for a Hail Mary and they didn't get it, so there was a little bit of pent-up selling pressure that was released once they got the rate increase. But again, 72 or 74% of people expected a rate increase. So I don't know what else you can ask for. Like I said, I think it was kind of a Hail Mary play. Everyone's just like, oh, the Fed meeting is coming up. Let's hope that they don't raise rates. That could be an economic boost. And they didn't get that. So it doesn't mean that people are actively selling on that news. I just think there was a little bit of pent-up selling pressure. You watched this morning stream, not live. We were looking at it to turn around. Oh, Best Buy, that was the one. Yeah, it didn't happen. Was it Best Buy? I was looking for a stock this morning, and I was trying to remember, and I think that's what Blair's talking about here. It was Best Buy. We were looking for maybe a bottom off of some signal. I don't see the signal, though, so it doesn't look like it was Best Buy. But if that's what you're referring to, that doesn't sound... Was it Best Buy? I don't see any place where I mean, I've got this down here. I've got this trend line here, but... No, something else was sitting right on a trend line, and I was looking for it to bounce. It was something else. It wasn't Best Buy. I'll have to... Yeah, it doesn't look right. I mean, there's no major support right here. There's a little bit right there, but I wouldn't have called... Support should come in at the top here. It shouldn't come in at the bottom of this. That's not really how it works. So, and we still haven't overtaken those highs, but we're still... Looks like forming a little bear flag here. Let's see what happens through the rest. Not sure if I'm going to make it to the end here. I got a super busy day, ladies and gentlemen, ahead of me. Christmas coming up. I have shopping to do. I'm sure some of you guys have as well for whatever holiday you're celebrating. I hope you have a good one. Hope I have a good one. Should be pretty good. Got a 4-year-old and a 7-year-old. Doesn't get any better than that. Maybe it was Goose. It was Goose. It was Goose. It was Goose. Yeah, it was Goose. We were looking for Goose. There's a trend line, I think. Was it a trend line? Or maybe it was a bounce off the 200-day. Anyway, that didn't work out. I don't know if it was... Yeah, I think it was Goose. I think it was Goose. TQQQ, scary time to buy. Possibly, Bled. That has been in the past. That has been a good thing to do, is buy when TQQQ is scary. It's a little scary right now. And with the Fed announcement, I think the market looks generally more scary. It could be, again, for longer-term bags, longer-term holders. This isn't for shorter-term trades. But TQQQ, as of these very low points, the thing about these low points is it's usually brought about also with elevated volume. You don't really have elevated volume today, so I'm a little skeptical about buying with the fact that there's no volume here. So we like we said a little bit ago, there's a little bottoming candle right there. This is a 5-minute chart. I usually don't hawk the 5-minute chart, but when you're looking for reactions at turning points, it's good to drill down. And so there's a nice little bottoming candle, but so far we haven't seen a lot of reaction to the upside, so I don't know if I'd be so inclined to buy this as a bottom. I'd probably rather wait for tomorrow to see the reaction. Even if it gaps up a little bit, I would probably still be more inclined to do that. But buying at this lower trend line so far has been an opportunistic, it has been a good trade has been good for the opportunistic trader. There you go. So yeah, if you want to buy here, I'm not necessarily super mad at that. But again, your stop point would have to be at the bottom of the candle. So if we undercut, you would definitely have to exit that position. Okay, that's kind of my feeling about that. Best to stay away from this correction. Bear starting to gnarl its teeth. Yeah, we're knocking on the door of a bear. We're at 18.5% down on the NASDAQ, so we're pretty close to a bear market. We're definitely in a deep correction, knocking on the door for a bear market. So take that for what you will. But so we got the rate raise, and looks like red is increasing on my screen here. You can see earlier that the greens were about this level. Now it looks like we've gotten a few more stocks in the red. AMRN at 2%. Send BLFS barely up. Twilio has been holding up relatively well. Looks like it's maintaining its elevated status. I don't think Twilio's that affected by the Fed, so a reaction would actually be abnormal, I think. But Twilio definitely holding up above the 10-week moving average here and above the 50-day moving average, which technically is around the same line, so good action there. But yeah, so far this little bottoming candle holding us up, but we're definitely not out of the woods by any stretch of the imagination. If you look at these prior, I'm going to zoom in on this cell here. If you look at these prior bottoms, you can see the buying on the first one was actually pretty dramatic. Buying on the second one, less dramatic. Buying on this third one, if we close in this area, obviously a little bit less dramatic. So we maybe we'll see a bottom fall out here at some particular point in time that will really scare the bejesus out of you. And maybe that would be a good day to buy TQQQ. But at this stage of the game, we're back to counting follow-through days again, or counting days to the follow-through day. And this is day 0. So if we don't undercut tomorrow, we would be at day 1. And then, so like in this situation, day 1, day 2, day 3, day 4, and day 5, we got a follow-through day. Didn't end up working out. We ended up going back into a correction. I believe this day, I believe this day went back into a correction. And so now we're back to day 0 in terms of counting follow-through days. But the bear, we're knocking on the bear. In my mind, what I was saying was, I think I even said this out loud, is undercutting this low, and we're pretty much going to go down into the bear market. We did that the other day. Yesterday was not very encouraging in terms of maintaining this level, and then today we broke right through it. Although volume is not very elevated on the futures, which is a little intriguing. So the fact that we have a low volume sell-off, that could be within of itself, kind of like we talk about stalling on the upside, that could be stalling selling on the downside. So that could lead to some TQQQ buying if you want to. Maybe, and I'm not going to say what I was going to say. But anyway, guys, I think that's about it. I think I'm going to end the stream right there. Look for a little bit of reaction into the close. The last 5 minutes to 1 minute, due to algorithmic trading, they usually wait till the very last minute to show their hand. But so far, this little bottoming candle has put in the bottom of the day, and it may remain the bottom of the day. And maybe we'll get a bounce out of here over the next couple of weeks, similar to what we did when we were touching that trend line. So look for that, guys. If you guys like the stream, thanks for joining me. Please like the video. Please subscribe to the channel. And we do a live stream here every single day. So if you do subscribe, you'll be notified when I start that stream in the morning. So thanks, Blah. Appreciate your appreciation. I'm glad you're here. Merry Christmas shopping. Yeah, right. Should be fun with the kids. Kids are gonna buy stuff for their moms and for each other. Yeah, it's going to be good. It's going to be a good time. So, all right, guys, there you go. We got our Fed rate hike, and we'll see if it was a buy the news scenario. We'll see that tomorrow. All right, guys. Hope to see you guys tomorrow morning. Thanks for joining me. See you next time. Bye-bye.